the less above ground available gold for investment there is, the more desirable silver becomes. Please understand that silver is an industrial metal now, and it's increasingly industrial, which means, and I'm not joking here, in the future, you're going to see silver become more and more utilized. What's going to happen is there's going to be less above ground silver available for investment, which is just going to make silver like gold. You're going to see, I believe you're going to see over time, gold gets remonetized, then gold's price will be more proportionate with how much gold is in earth. And if gold gets remonetized and there's less silver available to be used, then you're going to see the ratio converge, 15-1, whatever it is. But it's certainly not going to be 90-1.
The gold-silver ratio is still near historic highs, around 88, well above the typical peak of around 80, indicating silver is relatively undervalued compared to gold. Once this ratio declines below 80, it declines rapidly as silver plays catch up. This ratio decline could start with gold over $2,100. VinceLanci, the renowned market analyst with a deep understanding of precious metals, shares his insights on the current market. Vince foresees a lower gold-silver ratio with gold remonetization, while silver's industrial use is projected to grow despite increased costs. The market has rallied approximately 8% in less than a week. Silver, an industrial metal, benefits from improved risk sentiment, and the recent strong rally in stocks, accompanied by dollar weakness, has propelled the silver market higher. As world vaults deplete, Vince emphasizes the need to source silver from base metals. Notably, China and the U.S. seek alternative supply chains. Silver demand is expected to increase due to China's investment in photovoltaic technology, but demand for silver and gold for investment purposes will also be robust amid recession fears. Silver supply deficits continue growing, with the deficit reaching 237 million ounces in 2021 and potentially 160 to 180 million ounces in 2023, reducing available inventory. Once these reserves are depleted in the face of sustained deficits, likely within the next 1 to 2 years, the silver market will reach a pinch point. With demand still rising and mining output constrained, this risks sparking the conditions for a price spike or a discontinuity event where prices surge dramatically higher due to the mounting supply crunch. Now we present the clips of VinceLanci's insights from his recent video with Arcadia Economics. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
If we do have a recession, you're going to hear if there's less demand for lead and zinc in the developed world. I'm just giving you like an outlier here. If there's less demand in lead and zinc in the developed world, now in this case you got to put China in the developed world in that sense, then there's going to be less production of it. There's less production, there's less waste product, less silver available. Now, how important is this waste product? Well, 50% of it, okay? That's why silver is artificially depressed. One of the reasons. The economic reason is that if you're a lead and zinc miner, to simplify it, you pull it out of the ground, you pull the lead and zinc out, and then you say, what's this? And then you throw some acid on it and say, oh, look at that silver, and you hit the bid. And that's one of the reasons. A crucial supply source for silver is base metals. That's just a fact. And the reason this becomes more important is I want you to look at the silver that comes out of the base metal piles as a storage. As the world's vaults are filled with silver, right? They take the silver out. And as the world's vaults drop down, this is why I keep saying it's a flow trade. It's not a stock trade anymore. At least you can't see the stock. As the stock depletes, they start going to sources for it. In Latin America, they're not hedging silver anymore. Why? Because they're selling it out of the ground directly to China in concentrated ore form. Boom. All right. So you're not going to see that hit the vault, or it'll hit the vault, be tested, and be shipped. Simultaneously, what you have is countries like China and the U.S., I'm sure, are going to their banking pals, JP Morgan, Bank of America, and saying, you know what, we need more silver. Can you secure us a new supply chain? Remember, post-COVID, we have supply chain issues. So the banks go, sure. And they go to their clients that are lead and zinc miners, and they say, hey, you got any piles there? Yeah, well, pull it out. We're going to pay you for the silver. And that's what's happening. You're seeing the above ground silverware, your grandmother's candelabras, the silverware that's in your store being raided by the banks. And it happens to be piles of lead and zinc ore. Okay. So what you see is as the vaults go to zero, right? They're not going to go to zero, but as they get close to zero, they start raiding the other stuff. And then when that's gone, when that's gone at the current prices, then silver should have a minor explosion. Now, I don't know when this is, but that's how it works. And then we hit another level, call it 35, call it $50. And then more scrap comes out because it gets more expensive to pull the scrap out of other earths. But they start to do it. So you'll start to see scrap pulled out of, to simplify, you're pulling scrap out of phones, that type of stuff. But it's not cheap, so it doesn't get done overnight. Silver has to hit a level for this supply to come out. And, it's going to hit one of these levels very soon because the vaults are empty. They're tapping into the above ground scrap. Two reports I'm rereading today. This is primarily about gold, but they're precious metals, right? Look at the dates on these reports. March 2022, the stealth erosion of dollar dominance, and January 23, gold is the international reserve of barbers rock no more. These are central banks preparing their world. IMF is primarily European, although it governs, the earth in some way, preparing their people for the remonetization of gold. Now, how does that affect silver? Well, the less above ground available gold for investment there is, the more desirable silver becomes. Please understand that silver is an industrial metal now, and it's increasingly industrial, which means, and I'm not joking here, in the future, you're going to see silver become more and more utilized, even though it's going to get more expensive, because they're going to figure out ways to apply thinner layers of it, use less of it. But by using less of it, you can apply it for more things. So the cost per unit of silver goes down to $1 from $5, but the use expands for the masses. And silver becomes more and more and more industrial. You can't use copper in missiles. You have to use silver because you can't have any delay in electricity, things like that. Well,
during the interview, VinceLanci mentioned that silver ETF outflows have increased, indicating a disinvestment trend in silver domestically in the U.S. The silver ETF has been doing well as silver underlying has given a good upside since hitting the low of August 2022. The price is up by more than 40% in domestic markets. And the upcoming trend in silver is expected to remain higher and will likely keep ETFs in demand. As per Vince, potentially developed markets favor gold, and emerging markets support silver amid a weaker dollar. Silver will likely find support as long as the US dollar remains weaker. The greenback has started the new week lower, extending its losses from the week before, when the dollar index had slumped nearly 1.9%. Let's get back to the interview.
November gold ETF redemptions are trending at the slowest pace since May, despite weak year-end seasonals. Easing U.S. inflation and loosening labor markets create a favorable environment for the yellow metal heading into 2024. I will say this, ETF redemptions have slowed off, but they have been big for the last 6 months or so. I believe that we're in buy season, so you're not going to see people liquidating silver this time of year, if at all. Silver ETF outflows have accelerated month over month despite a collapse in the gold-silver price ratio to pre-Israel-Hamas war levels, suggesting pent-up demand might arrive in the coming weeks. Okay, that's an interesting statement, and I just want to frame it a little bit. Silver ETF outflows have accelerated month over month. So what they're saying is domestically in the US, you're seeing a disinvestment in silver, and meanwhile, you're not seeing a disinvestment in gold. This is also consistent with what we're seeing in the CTA marketplace, where people are buying gold for war risk and shorting silver for economic risk. It's kind of a precious aspect of precious metals, not the base aspect. So they're all not just shorting silver or liquidating silver. They're selling copper, they're selling aluminum, what have you. But that's because of what I just described. You're not going to see that anywhere else. But what I'm telling you is it's true. Okay, so both precious metals seem poised to rally in Q1 with higher developed market recession odds favoring gold, but an emerging market rebound supporting silver. For the week ending November 14th, commodity index, blah, 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 blah. Okay, you can see the numbers there. What does that sentence mean? It means that they're saying that there's a potential macroeconomic Goldilocks going on for precious metals. Developed markets are headed into recession, and that implies gold will have less pressure on it. We're not worried about inflation. It's a good explanation. Emerging markets, silver will have, which is a bigger exporter of silver, a bigger producer of silver. They seem to be rebounding economically. I look at these two things as the same things, meaning we're headed into recession. The emerging markets are coming out of recession. We're going to be easing rates. And so the catch-up comes like that. So silver leads and gold follows on the way out of recession. And that's how you look at these things together. Okay. Translation, silver is being shorted by, this is me. Translation, silver is being shorted by small funds buying the economy card still, which I just said, buying gold, selling silver. Shanghai buys again on a weaker dollar. They are, excuse my French there. That's little notes to myself. The buying is coming out of China. Consider China an emerging market. So if silver is being bought by China, while the U.S. CTAs are selling, then you have a recipe for a slingshot higher, provided the emerging markets continue re-emerging. All right. I think when the masses, when the less savvy firms say, "Oh, we'll just go to the Joe's, lead and zinc mining and we'll buy his silver," it's going to be gone. That piggy bank's already been raided. JP Morgan, Bank of America, Standard Chartered, they're all over that shit. China is buying everything. Turkey is buying now. Well, they were buying before, but Turkey is buying. And India, right? India, surprising for me anyway, they ramped up their buying again. And I really, it's speculation, but I think they're buying some for Russia as well. I can't tell. But let's just look at it this way. Indian demand, which bought last year in the $16 to $18 area, let's call it, right? They bought in the $18 area and should not be buying this year, at least not at these prices, is buying again this year.
Higher industrial production suggests economic growth and stability, boosting investor confidence. Meanwhile, more robust retail sales indicate healthy consumer spending, reflecting economic resilience. What factors are crucial for investors navigating the evolving silver market? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.